Don't worry though. If you're doing it for a bankruptcy class, they have no idea what value is. You can get away passing all kinds of crap for that. So
was about to say that's what I did for finance.
it's
Okay, folks. How many classes do we have left? You're saying, who's counting? I'm counting. Okay. We have 4 sessions left. The end is near. If I sound like that preacher on Times Square, you know, when the guy's still there, said, repent, repent, the end is near. Now, you don't have to repent, but the end is near anyway, which means things are going to be coming at you. Tomorrow, I'm going to send you an email. And I know some of you have not been reading my emails ever. I wanted to read tomorrow's email. It's about the project. It's about structure and format and what I'd like you to do on the project. So even if you've never read any of my emails so far, read tomorrow's email. Okay, it's going to kind of structure, because I know for many of you, you're hopefully getting to a point where you're asking, what do I do? I've done my DCF, I've done my pricing. How do I bring it all together? How does the project get turned in? Tomorrow's email should answer that. So today we're going to continue with the discussion of real options. And we're going to talk about, in particular, patents, non-viable technology. To set up the discussion, I'm going to ask you to think about a question. Okay, so this is an old example. It says uses cell phones, replace cell phone with AI. Okay, so let's assume that you're a small startup company. You've developed a new AI technology, very promising, but not viable today. I'll wager this is true for 95% of AI technologies right now. They're promising, but they're not viable today. What does that mean? It'll cost me about $2 billion to make this AI technology commercial, but based on the market that I see, I think I can make only $1.5 billion back. In capital budgeting, whatever I just admitted about the project, negative net present value, right? Minus $500 million, it's not a viable technology. Should you implement the technology today? Let's start with the easy one. No, right? It's non-viable. Let's assume you're now working for Apple or Amazon or Google. You're looking at this technology. It's not viable. Might you be willing, because this is a technology, the company has the exclusive rights to it for the next 15 years or next 10 years. Might you be willing to pay for this technology even though it's not viable today? Daisy, what do you think? Might you pay for a technology that's not viable? Okay, now you're on the spot. If you said yes, tell me why you would pay for something with a negative end. What are you hoping will happen? There's no stock price. It's the project, right? It's technology. So right now, the present value of the cash flows is $1.5 billion. It's less than the $2 billion. Nick? No, let's not bring in the word options. So right now, it's $1.5 billion in cash flows. It's less than the $2 billion. That's based on what I know today. You're hoping that things change. In the AI business, who knows what tomorrow will bring in terms of that $1.5 billion could become $3 billion tomorrow, right? $7 billion, $15 billion. I'm laying the groundwork for option pricing. You're buying the technology because it's non-viable because during that period, something good can happen. Is it possible that nothing good happens? Of course, in which case, what do? You throw the option to the trash can like any other out of the money option. And he said, that didn't work out. But let's stay on this. So clearly you're willing to pay for non-viable technologies where you have an exclusive right because good things can happen. Now I'm going to ask you some follow-up questions on that, right? So let's take this technology. I've told you I have exclusive rights to this technology. And initially you thought you were getting this technology for the next 10 years. And I come back and say, no, I think we have 15 years of exclusive rights. We're lengthening the life of this technology, the rights to this technology, increase the value of this non-viable technology, decrease. And tell me why. You have more time, right? Time is your ally. Something good. There's more chance of something good happening if you give me 15 years. Now, let me ask you a second question. There's a certain amount of uncertainty about the future, right? What if I say that the future is even more uncertain than you thought? What does that do to the value of this technology? It's a non-viable technology. This is amazing. We're ignorant. The more ignorant you get, the more value you attach. This is great. This is a great thing about options, right? You say, I know nothing. That's good. I know even less. That's even better. There's a lot of uncertainty. You see why uncertainty is your ally? If you are absolutely certain about this technology, how much should you pay for this technology? You'll pay nothing because it's going to stay at 1.5, be less than 2. You hope and pray that uncertainty can only do good things for you because you've already spent the money. You have the rights to the technology. If it stays certain, you're kind of screwed because you're never going to get to 2 billion. You're starting to see why options have a very different driver than everything else we've talked about so far. One final point. Let's suppose you get this technology because it's non-viable, but a year in, something good happens. The technology becomes viable. What does that mean? The present value of the cash flows is greater than the strike price. It's a viable technology. Would you develop the technology right away? Sebastian, you're nodding your head yes.
So, but there's odds that it now becomes unviable.
No, but that's always an issue with any project. But if you take it, what happens? So you now taken the project, right? Is there a value to waiting sometimes on, especially in businesses like this? Maybe you could get a better product if you waited another 6 months or a year, a bigger market. Because that's the nature of uncertainty, right? You can see that, did any of you buy call options on Tesla yesterday? You should be really happy if you did, right? Let's say you bought a D part of the money call option, a 160 strike price call option in Tesla. Stock was trading at 144 yesterday. As you know, earnings report came out after close of trading. The stock jumped $17. Your option is in the money. You could exercise and claim the profit and you'd make a neat profit. But if there's time left on the option, you're going to wait, right? So the same things that apply in option pricing start to kick in here. Once something becomes viable, before you pull the trigger, you're going to weigh off. What do I gain by developing it right away? You get a project and cash flows, but what do I lose? Which is, hey, if I waited, I might be able to develop a better application, more revenues. That push and pull is going to determine when technologies actually get developed. So we're going to use that insight to start talking about real options today. So let me go back to where I left you in the lecture note packet, where we were talking about option pricing. So if you get a chance, visit that binomial Black-Scholes. We did the dirty work of building up to option pricing. Today, we're going to do the fun work of applying option pricing models. Now, went the Black-Scholes model. Remember I said it was designed to value European options, basically options that you can exercise only on the expiration date. One of the features of real options is you almost always want to exercise early. I'll give you an example. We're going to talk about a patent as an option. In a patent, you usually get 17, 20 years of exclusive rights to the technology. Let's say you have 17 years in your patent. Do you want to wait till the 365th day of the 17th year to develop a patent? Or do you want to develop it earlier? What? You want to develop it as soon as it becomes viable. Maybe not immediately because it not be viable, but at some point in time, well before the 17 years, because if you wait till the end of the 17th year and you develop it, you get no protection. You've used it up. Real options get exercised early, and option pricing models, especially the Black-Scholes, were designed for options that never get exercised early. And there are purists out there, and I hate purists because they're purists, who argue that you should never use a Black-Scholes model to value real option because real options get exercised early. The Black-Scholes is a European option. And I say, okay, you have a point. What do you want to use instead? So I want to use a binomial model. I say, okay, draw me the binomial model. You have a real option with a 10-year life. God help you drawing the binomial model. So people talk the talk, but they don't want to walk the walk. So you know what I'm going to do? I'm going to say, look, I'm going to use the Black-Scholes to value real options. I know that real options get exercised early, but if I use the Black-Scholes to value an option, I'm getting a lower bound on the value, right? That same option, if I allow you to exercise early, will be worth more. So when I tell you based on a Black-Scholes model that a patent is worth 8 million, if you want to bring in the early exercise, it's going to make the number greater than 8 million. I'm okay with that. It's a conservative estimate of value. So I'll make up front, I'm going to use Black-Scholes models all the way through this real option section. If you show it to one of your purist option friends, I hope you have no friends who are purist option friends, but if you do, there's no Black-Scholes model. Just tell them basically that that's okay. As long as they come back with a binomial model that does the same thing, you're willing to listen to them, they'll never come back, which might be a great way to get rid of these people as your friends. So it is imperfect, but it does the job. One final thing, if you draw a binomial tree, and if you remember the binomial tree, the stocks, notice I didn't attach probabilities in a binomial tree because I didn't care, because the replicating portfolio and the option get affected the same way. If you start to attach probabilities to the branches in a binomial tree, it becomes a decision tree. Have you seen decision trees in statistics? It's a tactic for bringing in uncertainty. And if you can draw a full decision tree, you can get everything we get with option pricing models without ever bringing in an option pricing model. I think we underutilize decision trees in analysis and valuation, because decision trees are designed for risks that are sequential and discrete. You know, by sequential, right? There's stage 1 and a stage 2 and a stage 3. You got to get through each stage to get to the next stage. And discrete, which means success and failure are clearly delineated. It's not like earnings are high or low, because that's a continuum. So what kinds of companies do you think are exposed to sequential discrete risks? Pharmaceutical company, especially when you're developing a drug, right? You see the sequential part, there's a stage 1 and a stage 2 and a stage 3. You got to succeed at each stage to get to the next one. And if you can attach probabilities to each stage, you can actually draw a decision tree for a drug. So I'm going to try. I'm not a pharma expert, but actually this is from, it's actually a chapter in one of my books about dealing with uncertainty. The book is called Strategic Risk-Taking. I wrote it a long time ago. I've forgotten what I wrote in the book. It's been so long. But this is one of the decision trees I drew to kind of illustrate the process. It was to estimate the value of a diabetes drug that a company was thinking about doing research on. So they haven't even done the research. The question I ask you is, we're thinking about doing research on this. This is what we know. Should we do the research? Now, before you do that, you want to see, is the expected value of doing research going to be good? So you basically take the process and you test whatever the drug is. If the test works, you say, okay, I'm willing to go to the next stage. So if you see, each one is a stage of the process where you're testing the drug. And along the way, you'll discover either the drug doesn't work, in which case you abandon the drug, or it does, and it works only on type 1 or only on type 2, on both type 1 and type 2. So you're learning as you're going along. Remember, we talked about learning and adaptive behavior. Each stage, I'm learning, I'm adapting. And at the very end, I've estimated what the value of the drug will be under all of the possible outcomes. The best case outcome is it passes every stage. It's good for both type 1 and type 2. I get a value of $887 million for the drug. And every other value is going to be for, lesser outcomes, maybe just type 1, maybe just type 2. You're saying, what are those negative values? Those are the scenarios where at every stage it looked okay, but then at the very end, you really got the lower end of the spectrum. It's not enough to cover all your costs. So you're saying, why would I do it? You didn't know it when you started, right? Because by the time you got there, it was called a sunk cost. I'm essentially listing out all the possible outcomes. Because of probabilities, it's called rolling back the decision tree. You start at the end and you work back on expected values. You take the probability times the value, you work it all the way back, you come up with the value of 50.36 million today. That's the present value of all these probability adjusted expected values. What does that tell me? You should do the R&D now. Can I guarantee you'll make money? Of course not. But on an expected basis with the probabilities built in, the upside and the downside, that is the expected value. If you have a small pharma company with a single drug driving its entire value as a company, you might be better off using a decision tree rather than using a DCF model and revenue growth and margins, because this is designed for the kind of company you value. So that's a decision tree. It's something you don't see used very often, but if you can do it, you don't need any of the ammunition. The way I describe option pricing models, it's like having a bazooka launcher. If you have an ant in your living room, please don't use a bazooka launcher. You'll kill the ant, but you'll probably blow up your house. The problem with option pricing models, you start to use them, they're so neat, you want to use them on everything. Small problems, big problems, reserve option pricing models for where they have the most use, where they have the biggest value. And sometimes decision trees do the job. You don't need an option pricing model. Question? That's a good question. So give me some ideas. Let's say I have a diabetes drug as a pharmaceutical company. How do you come up with the probabilities of success at stage 1, stage 2, stage 3? First, are there other companies that have gone through drugs? So basically you look at, in fact, the FDA, that's public information. You can look, stage 1, there's a much higher chance of failure because by the time you get to stage 3, about 83%, basically the probabilities change. You're going to draw on past history. You also know the quality of your drug, right? So in a sense, is it a big change? Is it an incremental change? So you go in with expectations. So it's going to be a combination of both information about the drug you have as a company, as well as the information about the FDA approval process and how it's going to play out. And time value is built in because this takes time. You'll factor in it takes 7 years to go through the process. That gets built into the values. Question? No? Yeah. So now let's talk about the 3 questions we're going to ask with real options. Because as I said, you want to be a skeptic. You want to ask the right question. So when I come to you with a real options argument, first, you're going to ask, is there an option here? Should we even be using option pricing? Second stop, is there exclusivity? Remember, with complete exclusivity, you get complete value. With no exclusivity, you get none. Where in the spectrum do you fall? And third, can I use an option pricing model to value it? We need to be able to replicate an arbitrage. Are we close enough that I can bring the Black-Scholes model down? I'll tell you, every day I hear people use the word optionality around me. I hang out with a very strange group of people. And part of the reason is, especially if you've gone through an MBA and you hear the word in your strategy class, there's optionality, because this has become the magic new word for strategic. There's optionality here. Okay? There's an option here, there's an option, there's an option behind the bush. For every 100 option arguments I hear, maybe 2 make it through this 3-step process. Somewhere along the way, the remaining 98, like, there's no option there, or there's no exclusivity there. Keep that as your way of screening through the options that matter from the ones that don't. So let's talk about the first set of options. There are options that you're going to see in project analysis. You take in your corporate finance class, and remember how you're asked to assess projects. You take a project with a 15-year life, you project out the expected cash flows, you discount back at a risk-adjusted discount rate, you come up with the net present value. The net present value is positive. You take the project, the net present value is negative. You reject the project. It's corporate finance 101. And I'm going to kind of poke a hole in corporate finance 101. That tells you whether the project is a good project or a bad project today. But there are 3 options embedded in projects that net present value ignores. So first is the option to delay. You know what that means? A project has a negative net present value, the example that we just did today. But if you have exclusive rights to the project, you might be able to make this project work for you too. That's the option to delay. The second is the option to expand. A project might have a negative net present value, but if it gives you a chance to do something bigger down the road, and we'll talk about what that might be, an expansion investment. That's an option to expand. And the third is you enter into a 15-year project. What's your nightmare? 2 years in, you realize the project is delivering half the cash flows you thought you were, and now you're stuck with the project, right? Wouldn't it be nice to be able to walk away from that project, shut it down? That's called the option to abandon. All three options have value, but you know where this is going to lead. You can have a negative net present value for a project, but if these options have enough value, you might be still inclined to either pay for the project or take the project in spite of the negative net present value. So we're actually breaking Corporate Finance 101's basic rule of don't take negative net present value projects. And you always want to be careful when you do that. So I'm going to take each of these options separately and see how they play out. Let's start with the option to delay. As I said, when you compute the traditional investment analysis and come up with the net present value, the answer is a simple question. Should I take this project today? It doesn't tell you whether this project is valuable if you have exclusive rights. So remember each option I said, I was going to start off with a payoff diagram to show you that it's an option. Here's what the option to delay looks like in a payoff diagram. The underlying asset is the project, right? That you have exclusive rights to. The present value of the cash flows in the project becomes the equivalent of the stock price. The amount you have to invest in the project becomes the equivalent of the strike price. So right now, what did I say about this project? It's a negative net present value project, so the value is less than the strike price. But over the life of this of your right to the project, that could change. And if that changes, you're going to take the project, you're going to claim the net present value. Of course, you could be wrong, in which case, what do you lose? How did you get the exclusive rights to this project? You either paid somebody, you did R&D, you got something invested in, that becomes the cost of the option. I'm going to use this option to delay to look at two big options we run into in valuation all the time. The first is a patent. Everybody knows how patents work in the US system, right? They've been around for 200 years. There's a fascinating history of patents. Now, the pictures, because in the 1800s, you see Alexander Graham Bell draw the picture of the phone. And if you read your history, he and Nicholas Tesla were in this race to who got there first. And legend has it that Tesla got there first. Alexander Graham Bell had the better connections, and he ended up becoming a billionaire, and Tesla ended up as this bitter poor man. I don't know whether that story is true or not, but patents are here. The way patents work in the US is you can patent pretty much. It's infuriating in some sense. People, I remember, anytime you see that R right next to this, you know that guy has patented it. I remember when, early on I was doing, when I was teaching this class, I get a threatening, wasn't even emails that long ago, letter from a lawyer from somebody who said, you're violating our patent. I said, patent to what? They said, my client invented price to sales ratios. I said, really? What part of it did he invent? The price or the sales? The division, he said. Nobody had ever done that before. I said, whenever I multiply, should I check with you too? How about if I take the product and then divide? But let's face it, you can try to patent pretty much everything. How good but you get exclusive rights to develop that patent into a commercial product for 15, 17, 20 years. The key word is right. You don't have to, nobody forces you. Do you see the optionality here? Let's assume that converting this patent into a product will cost you I. It's an abstraction. It'll cost you I. Let's assume the value, if you develop the patent today into a product, is V. If V is greater than I, you'll develop the patent, keep the difference. If V is less than I, what will you do? Sit on the patent, hope that something good happens. So look a lot like a payoff on a call option. In fact, if I drew this as a payoff diagram, the cost of converting the patent into a commercial product becomes the equivalent of the strike price. The present value of the cash flows from developing the patent becomes equivalent to the stock price. If the present value exceeds the cost, you develop the patent, you keep the difference. If that doesn't happen, you write off whatever it costs you to get the patent in the first place. And what are the two ways a company can get a patent? It can, what? It can buy it or build it through R&D. R&D is in a way the cost you're paying. So I think of R&D as a price that pharmaceutical companies do to acquire to acquire options. Some of those options will be in the money, some will be out of the money. You're hoping the in the money ones are really in the money. There's the optionality. So I remember seeing this very early in the 1990s. I said, that's interesting. I'd like to see it tried out. And I couldn't find a really worked out example. People could draw the diagrams and it's an option, but nobody wanted. So I wanted to try to put some numbers. So I'll give you my best try, because to convert this picture into option pricing, I've got to come up with the inputs in an option pricing model, right? So let's say you come to me with a patent, say, value the patent for me. I want to take what you've given me and give you S, K, R, T, and sigma, because then I can use an option pricing model. So let's get started. You have a patent, you want me to value it as an option. First step is I need to get a value for the underlying asset. What's the underlying asset? If I develop the patent into a commercial product today, what will my cash flows look like over the life of the project? When I ask you to do this, you know what your pushback is going to be, right? It's a patent, no product has ever come about it. I feel really uncertain. And I'm going to say, good. Because this is an option, right? If you felt certain there'd be no option, right? Of course you're going to be uncertain. Make your best estimates. So you make your best estimates, you come up with expected cash flows, you come up with the present value of cash flows. That becomes the S in the model. Second stop, I'm going to ask you, do you feel certain about this number? And your reaction is far from it. I'm very uncertain. And I'm going to try to push you to tell me how uncertain you are. That sounds mysterious. Remember we talked about Monte Carlo simulations? In a Monte Carlo simulation, what do? You come up with an expected value and you also give me a distribution of values. One of the nice things about doing a Monte Carlo simulation is you get a variance in value. That becomes the variance used for the option pricing model. If you complain and say it's too much work, I'm going to let you take a shortcut. If your patent is in software, I'm going to say, can you look at the stock price variance of software companies? Maybe there's a reason for that and use that. It's a shortcut. It's not perfect, but I need a variance. So I've got a value, S, I've got a variance, sigma. I need a strike price, right? What is a strike price? It's a cost that you will have to incur to convert your patent into a commercial product. If you're a software company, you actually have to set up an infrastructure for taking the software and essentially make into a commercial product, salespeople. That infrastructure becomes the K in the model. I've got S, I've got sigma, I've got T. Okay. What's the life of this option? It's a patent. It comes with a life. The clock is ticking. I'm going to ask you how many years are left on your patent. That becomes the life of the option. And the riskless rate it's from MAC. That's the only variable that I can look up. It's going to be the T-bond rate reflecting the remaining life of your options. If you have a 15-year life, I'm going to look at a 15-year risk-free rate. Let's try this. I'm going to take drug, and this is a very old example, and I'll tell you why I've stayed with this example from the late 90s. Of a company called Biogen. It's still around. It's a biotechnology company. This was when they were a very young company, and they developed a new drug called Avonex for treating MS. Okay. So basically, I'm going to try to value this drug as a patent. So the reason I was able to do that is basically I was able to get some internal documents. Because what's the first input I need? I need the present value of cash flows from developing this MS drug right away, right? I was able to get my hands on an internal document that Biogen had projected. Have you ever seen one of these cash flow projections in pharma companies? It's kind of terrifying. Because here's what they do. They start with the population of the US and what percentage of people have MS. It's actually a statistic that they can estimate pretty well. So let's say 8.3% of the US population is MS. Then they'll take the percentage of those people who will go to a doctor. And it's not 100%. So let's say 90%. Everybody say, what about the remaining 10%? No, they have no insurance. They don't even go to the doctor. They have MS. It's undiagnosed. It stays on. Of the 90% that go to a doctor, they ask what percentage get the right diagnosis? And the answer is not 100%. Kind of a terrifying thought. And then they look at the percent of people who have MS who actually can take the drug. And it's not 100%. Why? You don't have insurance, your insurance won't cover it. So basically, they start with the population, they build up to and then they look at what can we charge for the drug, and that comes as a factor of what will insurance companies pay, what will Medicare pay. It's a very morbid exercise because you're going through the process of coming up with a drug that's central to somebody's life, and you're attaching a number to it, but you're a business. Based on their projections, they estimated that the present value cash flows from developing this drug right away would be about $3.422 billion. I want that to be filed away. That's a present value of cash flows if you develop the drug right away. At the time that I did this, Biogen had a couple of drugs out there, but they'd licensed the drugs. They had no infrastructure for actually developing the drug. They wanted to develop this drug themselves. And I estimate it would cost about $2.875 billion for them to create the infrastructure to be able to sell the drug together. You're saying, why they're spending so much? It's not just manufacturing, but if you ever gone into a doctor's office, sometimes you see the pharma salespeople come through. It's an entire game in itself. Right? It's a big expense, selling expense. They have none of it. They've got expended $2.875 billion. Let me pause right there. If they develop the drug right now, it's what, $3,422 million. The cost of developing it right now is you got to spend $2,875 million today. That difference, $547 million. If this were a corporate finance class, what would that number be? Present value of cash flows minus initial investment is? That's your NPV. This project has a net present value of $547 million. I want to file that away. So in corporate finance, we'd be done. It's a positive net present value project. But I want to think of it as an option. Remember, they haven't developed the drug yet. They have 17 years left on the patent. That becomes the remaining life of the option. The risk-free rate over those 17 years is 6.7%. And then I came to the variance part, and this was 1997. There was no crystal ball for me to use, no easy way to do simulations, so I cheated. The way I got the variance was by looking at publicly traded biotech companies and how much their stock prices move, arguing that that reflects the uncertainty about the cash flows in the business. It's an approximation, but it's a very, very volatile business, 20.224. Is this a viable drug right now? Present value cash flows is greater than the cost of developing. NPV is 547 million, right? Will they gain something by waiting? Yes, they will learn more about the drug, maybe make it a better drug, but will they lose something by waiting an extra year? They lose 1 out of the 17 years of protection they have, right? Because remember, they have only 17 years of protection from competition, so that becomes the cost of delay. It's like a dividend yield. Each year you wait, you're essentially giving up something. So I'm introducing a cost of waiting, because if I didn't do that, you would not develop the drug till the very last day of the 17th year. And I'm trying to put a pin and say, you know what, you should do it. With those inputs, the value that I get for the call option is 907 million. I want to step back. What's the net present value of this project? 547 million. Think of that as an intrinsic value. The option value is 907 million. I'm adding an extra 360 million to the 547 million. Where is it coming from? What's that optionality? Where's the value coming from? That by waiting, you can learn more about the drug, develop a better drug, perhaps have higher cash flows. That's a 360 million. But this is really bad news if you have MS, right? Because you know what the message here is to Biogen. Not only am I giving them an option value, I'm also telling them whether they should develop the drug today. If they develop the drug today, what happens? It becomes a traditional project with a $547 million value. By waiting, they actually make the... I actually took this and I said, how long would they wait before you get a flip? The reason each year you wait, the cost of delay goes up. Remember, it goes from 117 to 116 to 115. It turns out that if I let this play out, they'll wait about 8 to 9 years before developing the drug. So if you have MS, you're sitting there, when I heard about this drug, it doesn't seem to be coming out. Yeah. I will give you the consolation price here if you have MS. In this case, they actually developed the drug about a year in, not 8 years in. There's something in my calculation then that I am getting wrong, right? How many years of protection did I said they have from Technically, that's right? I have a patent for the next 17 years against what? Somebody else developing exactly the same drug as I have for MS. You know what? It doesn't give me protection, Andrew.
The rival.
Other company, in this case, Merck and Pfizer and Upjohn were all working on their MS drugs, and I had about a 5-year or a 6-year lead time before they came out. You replace this 1/17th with 1/5. You have only 5 years. That's going to push up your cost to delay to 20%. The value of the option actually will drop below the 547 million, which will tip you into developing the drug early. You see the implication of this, right? If you live in a comparative pharma place where lots of companies are trying to come up with drugs for a disease, the optionality goes away because you're going to develop the drug the minute it becomes viable. But if you're the only game in town, nobody else is working on a drug for this disease, you're going to often delay it well beyond what your patients would like to because, now I remember when Glaxo controlled the ulcer business. Now and now imagine having a 95% market share of the ulcer business, and internally you come up with a better ulcer drug at Glaxo. Ask yourself, am I going to be in a rush to get the drug out? The answer is absolutely not. I own the market already. Why would I be in a rush to beat myself? I'm going to cannibalize my own sales. So there are policy and economic implications here because it means that when companies develop drugs and even after they become viable, you might not see immediate development, especially if they don't think there's anybody close by. So let's extend this out to trying to value a company with patents, because this is the value of a single patent. You're saying, I want to value a pharmaceutical company with the patents embedded. You can actually value a pharmaceutical company in 3 pieces. The first piece is if they already have commercial product that they've developed, remember, you can just do a traditional discounted cash flow valuation. That's the first slice. The second is if they have patents, you can value each patent separately, just like I did Avenex, add that on. And there's a third piece that's a bit of a nightmare. Remember, there's a continuing R&D department. Why do you keep all those scientists around? What are they doing R&D on? What do you hope they will do? Come up with new patents in the future that you can convert to new revenues. That third slice can add value, can do nothing for value, can destroy value. You got to bring all 3 slices in. The one thing you have to be careful about is when you do this, be careful that you're not double counting. I'll give you an example of double counting. After I wrote this piece on Avenex and taught it in a class, so an equity research analyst, a pharma equity research analyst wrote to me and he said, I took your teachings from class and I applied in a company, and can you take a look and tell me whether I did things right? So what he'd done was a discounted cash flow valuation of a pharmaceutical company with 2 blockbuster patents that they just acquired. He did the DCF value, then he valued the 2 patents, and he did a pretty good job on valuing the patents as options. And he added the value of the 2 patents that he'd valued to the DCF value. I had to ask him a question. You know what the question I had to ask him was to make sure there wasn't double counting. When you do a DCF value, what do? You project out growth and margins. So what's the question I need to ask him? When you did your DCF, how did you get the growth? And he said, I used a high growth rate. And I said, why? He said, they have these 2 patents. I said, that's interesting. So you put in the growth rate, you gave them the higher growth rate, you gave them, and then you added the option value at the end. That's double counting. If you want to do the option value separately, when you do your DCF, you got to value your company without those options with a much lower growth rate. So be careful that you're not. So if you've done a pharmaceutical company valuation, they have a patent, don't do the option pricing on the patent, just add it on because you risk double counting. Yes?
If you do incorporate the extra code, can you count for the additional risk in the discount rate somehow?
You could, but remember, much of that risk is company specific, right? It shouldn't be showing up in your cost of capital because as an investor in a pharma company, much of the risk is going to cut across companies. So, but people often try to bring in the discount rate. I think it's a mistake because it'll affect your expected cash flows, but it's really not a discount rate risk. So let me try this for Biogen. At the time that I valued Avenex in 1997, Biogen had 2 other drugs out there, one to treat hepatitis B and another drug called Intron. I forget what, 2 drugs that they'd licensed out to other pharmaceutical companies. And the way they'd license them, and this is going to become critical to how I value this, is they'd license them for fixed fees. Basically, that the companies that acquired the licenses agreed to pay 50 million every year for the next 12 years to Biogen. So how do we value a stream of 50 million a year for the next 12 years? You take the present value, right? And you have to discount those cash flows. So let's talk about the discount rate you would use. What are these cash flows that are guaranteed by Merck or Pfizer? So what's the risk you will not receive them? If Merck or Pfizer go bankrupt or default, they're going to default on this as well. See where this is going to lead me. The discount rate applied to get the present value of these cash flows was not the cost of capital. It was actually the cost of debt of the guarantor companies. In this case, Merck and Upjohn, because that's a risk I face. I think we need to be careful because I think we get locked into cost of capital discount rate. This is not a cost of capital cash flow. It's a cost of debt cash flow. The present value of those license fees was about 397 million. That's the present value of the two drugs they've already licensed out. So this is on top of the Avonex patent. They have those two. And then I turn my attention to the trickiest part of the Biogen valuation. They have an existing R&D department that they're growing 20% a year. So it's 100 million that they spent last year. It's going to grow 20% a year. That's the amount they're going to spend. But why are they keeping this R&D department going? Because they hope the R&D department will turn out new patents and new drugs. And here's where I had to make an estimate, and I'll tell you where I made the estimate, why it should make you a little queasy, as I estimated that every dollar they invested in R&D would create $1.25 in value. So how the heck did you come up with that? If you have a company that earns its cost of capital, for every dollar you invest, what do you get back? You get $1 in value, right? That's the essence of earning your cost of capital. I took the return on capital of small biotech companies in 97. It's about 16%. The cost of capital is about 12%. If you're earning about 4% above the cost of capital, I asked, if I invested $1 in this business, what would it be worth? If I earn 16%, the answer is more than $1 because I'm earning more than my cost of capital. It's about $1.25. Could I be wrong? Of course. So here's why I'm going to bring that in. I'm going to say, look, there is added value from R&D, but I'm uncertain about this number. So I'm going to use a much higher discount rate, a cost to capital young pharma companies of 15% to come up with the value. So there's my R&D cost growing over time at 20% a year. There's a value pattern, which is just the R&D cost times $1.25. The difference between those two is the excess value I create each year. I discount that excess value back at 15%. The present value that I get is 318 million. If I'd been earning my cost of capital, this table will become very simple, right? There'll be my R&D cost. What would my value patterns look like if I earned exactly my cost of capital? It'll be equal to exactly my R&D cost. The excess value will be 0. Present value of 0 every year will be 0. Is it possible that I could earn less than my cost of capital in R&D? Yeah, if I have a very inefficient R&D department, in which case I'd be earning 80 cents on the dollar. My value patterns will be less than the cost. My excess value will be negative. R&D can add value, destroy value, do nothing for value. And I'm actually making it explicit. So I bring those three numbers together: existing products, the patent and Avonex, the present value of R&D. You add the three up, you come up with 1,622 million. You know what this is? Where you, if you're doing a traditional DCF, what this is comparable to when you take free cash flow of the firm and discount it all back to the cost at the cost of capital. What you get is a present value, value of operating assets. I've gotten there with a different pathway by starting at the bottom and building up. Don't try this on a Merck or a Pfizer because you're going to drive yourself crazy. Do you see why? You probably will have to value 80 separate patents. And at that stage, it's a law of diminishing returns. Big pharma companies stay with traditional discounted cash flow valuation. This is best suited for small pharma companies that are getting the bulk of their value from a single patent or a couple of patents, because then the optionality is going to be a big factor driving that value. So value per share based on this estimate is about $45.70. So let's pass patents through the test. Is there an option? Yes. The underlying asset is the drug that comes out or the product that comes out of the patent. The contingency comes from the value of the cash flows has to be greater than the investment you have to make. So passes the option test. Is there exclusivity? Where does it come from? But patent and the government's willingness to enforce your patent. So if you live in a country where the government says, you know what, patents, no patents, who cares? There's no optionality. Don't do any optionality evaluation. The government doesn't enforce patents. The whole thing goes into dust, right? And can I use an option pricing model? What do I need for an option pricing model to work well? I need to be able to replicate, which means I need to trade the underlying asset, which in this case is the drug or the product, patent. I can't do that. And trade the option, which in this case is the patent. I can't trade the option. I can't trade the underlying asset. I'm on really dangerous ground using any kind of option pricing model. What does that mean? It's not that I cannot use the model. I did. But if you ask me how much faith do you have in the 907 million, I'm going to say, look, I'm going to compromise. You offered 750, I'll take it. Because since I can't monetize it, I can't take a stance at 907 or nothing. It is much more difficult for me to take a stand because it doesn't meet the requirements for an option pricing model. Any questions on patents? And so this can be applied to non-viable technologies, exclusive licenses. It's a way of thinking about what drives value. Let's move to a second example. Okay. Suppose you're an oil company. You have reserves, right? Oil reserves. Some are developed. What does that mean? The reserves have been opened up. You're generating oil. There's cash flows. They're traditional discounted cash flow valuation. But you also have undeveloped reserves. And you have the right to develop the reserves, right? Let's suppose the cost of developing the reserve is X. And the value of the oil under the ground is V. So let's think through the decision process. V is greater than X. You're going to develop the reserve, claim the difference. If V is less than X, what are you going to do? You're going to get down in and say, please God, let there be another Middle East crisis, because that'll make the oil price go up. No? It's an option, right? If I drew it as a payoff diagram, here's what it'll look like. The cost of developing the reserve becomes the strike price. The value of the oil under the ground. How does an oil company know how much oil there is under the ground? They have geologists who knock rocks and, you know, oh, that rock looks oily or whatever it is. And you know what? Their track record and estimation is much better than the typical equity research analyst. So we shouldn't take, but they say there's 80 million barrels and, you know, and you build that in. So that becomes the S in the model. Could you have a non-viable reserve today? Yes. Could it become viable in the future? Absolutely. You know what causes a non-viable oil reserve to become viable? Is the oil price changes. If that happens, you develop the reserve, you claim the difference. If it doesn't happen, you say, look, whatever I paid for that reserve, it was a mistake. I shouldn't have done it. How do oil companies end up with reserves? How do they get there? I know they do development and exploration. That just tells you whether there's oil in the ground. You can't, if you find oil, you can't just say, I'm going to take the oil out. You actually, you have to buy the rights to these reserves, right? There are auctions that governments run. And in the auction, you go in and say, I'd like the rights to that reserve for the next 20 years. You bid in an auction, you win the auction. You now have the exclusive rights to get the oil out of the ground. There's optionality here. Yes, Max. Well, royalties are the, once you won the auction and you get the oil out of the ground, the government doesn't let you go off scot-free. For every dollar you get out of the ground, you got to pay a royalty to the government, which is essentially like a variable cost, right? Well, that's not an option. You know exactly what it is. How much oil you get out of the ground, whether you develop it is an option, because the government can't force you to develop the reserves. You might choose just to sit on them. So the optionality comes from whether you will develop and when you will develop. Okay. So let's talk about converting this again into tangible inputs in option pricing model. I ask you to value an oil reserve. First, you're going to try to find the value of oil under the ground. Hire a geologist, tap the rocks, say this is how much. That becomes the S in the model. The value of oil based on the oil price. The cost of developing the reserve. Do oil companies have a pretty good idea of how much it will cost them to develop a reserve? Yeah. And will it be the same around the world? I think in Saudi Arabia, you go kick the sand. The reserve gets developed, the oil comes out. In Canada, you know how you get oil out of the ground? You go down 5,000 feet, you have to unfreeze the damn oil, it's frozen, and you got to bring it out of the ground. Cost of developing reserves varies across the world, but in any part of the world, you know with a pretty good idea, this is what it'll cost. That becomes the K in the model. The time to expiration. Remember I said you get this reserve in an auction. You don't get it in perpetuity. You get it for the next 16 years, the next 18 years. That becomes the option life. The variance here is a very simple one. You have a pretty good sense of how much oil there is in the ground. You know what varies across time is the oil price. The variance in value becomes a function of how much our oil price is going up and down. Once oil reserves become viable, you're going to be tempted to wait. You know why? The oil price is 60s. Maybe it'll go to 80. Maybe you should wait. But I've got to put in a cost of waiting, which is if your reserve is viable, what do you give up? By not developing the reserve, you give up the cash flows you could get. That becomes the equivalent of the dividend yield. It's a cost of delay. And finally, there is a difference between natural resource reserves as options and pretty much every other option. If you bought that Tesla call option yesterday, congratulations. You decide to exercise it. How long does it take to exercise an option? An actual instrument? It's like 1 minute. You get on, I have Schwab online. I can exercise the option. They mail me the cash. But let's say ExxonMobil decides today that they're going to, because oil prices are $100 well, they say, we're going to develop the reserves around the world. You think oil's going to come out of the ground tomorrow? They're probably going to call around and then engineers go running off to places. They put up rigs. And if you're lucky, 2 years from now, oil comes out of the ground. You see why this is going to lower the value of the option? You made the decision when oil price is 100. By the time oil comes out of the ground, who knows what oil prices will be? There's a time value effect. That's called the development lag. So I'm going to try to bring them all in with an actual company. Again, I'm going to go back in time and I'll tell you why this example hasn't been updated to a company today. A company called Gulf Oil that had been targeted in an acquisition because it had lots of undeveloped reserves. It had 3,038 million barrels of oil under the ground with a cost of developing of about $10 a barrel. So right now, if they develop all these reserves, it'll cost them about $30.38 billion to develop all the reserves. At the time that I looked at this, they had a remaining life of about 12 years on the reserve. So as I go through each one, think about why it matters from an option pricing perspective. They have 12 years to make the decision. The oil price at the time was $22.38, and the variable cost, and this is where the royalties would show up. Some of those variable costs are royalties. So they make $15.38 per barrel that they extract out of the ground. The T-bond rate was 9%. This was the 1980s. We're talking about US Treasuries at 8, 9, 10%, much higher risk-free rate. And finally, if Gulf Oil developed these reserves, their cash flows will be roughly 5% of the value each year. So think of that as what they'll give up if they choose not to develop the reserves. Oil prices were relatively stable in the 1980s, so the variance in oil price was a pretty low number, 0.03. I have everything I need to value the undeveloped reserves as an option. So I'm going to try to do it. So here's the question I'm going to ask. If I develop all of these reserves right now, what would the value of oil be? It'd be silly for any oil company to develop all their reserves instantaneously, right? I mean, that's a lot of oil to try to sell, but let's say you did it. At the price then, $22.38, you'd make about $15.38 per barrel of oil times 3,038 million barrels. But remember, you give up the cash flows of the first 2 years because it's a 2-year lag before the oil comes out of the ground. The present value of the cash flows, if you develop all the reserves today, is $42.38 billion. But to make this happen, you got to spend $30.38 billion right away. If I stop right there, 42.38 minus 30.38 is 12 billion. That's my intrinsic value or a DCF value for these undeveloped reserves. But they haven't developed the reserves, right? They can choose to develop them. There's optionality. They have 12 years of life. The variance in oil prices is 0.03, so good things can happen. 9% risk-free rate. And these are viable reserves. By not developing, they're giving up cash flows, so that becomes your cost of delay. I put it into the option pricing model, S, K, R, T, sigma. And Y, the dividend yield, the cost of delay. I come up with D1 and D2 and N of D1 and N of D2. Do you remember what I said about N of D2? What did I just say N of D2 was a rough measure of? The probability that S will be greater than K. What's S here? the value of the oil is going to be greater than the exercise price. There's a 85% chance that these reserves are going to be developed. They're viable reserves, 85% chance. The value of these undeveloped reserves, valued as options, is 13.3 billion. What is my DCF value? 12 billion. Where's the extra one? This is like magic. Where did the extra 1.3 billion come from? What's the extra value? Here's the extra value. As an oil company, you get to observe oil prices and decide when to develop the reserves, right? Right now it's 22.38. You say, I don't want to develop the reserves today. Oil prices jump to 40, you develop the reserves. They go to 10, you don't do anything. There's optionality because you can watch the oil price and change how much you produce. That's worth some money that they can't bring into a DCF. I'm bringing it in as a premium. In fact, to see why it's the optionality, if I make the variance in oil prices 0, you know what will happen to the value of this option? It'll become 12 billion. The entire optionality will go. This is coming entirely from the fact that oil prices are uncertain. And that's giving me an advantage as an oil company manager because I can choose when to produce and how much to produce. So in the case of Gulf Oil, I completed the valuation by bringing that in. Yes. It's not even discounting. I just take out the first 2 years of cash flows. Why? Because the first 2 years I get 0 cash flows, right? So it's a traditional, so you could actually have done a capital budgeting starting in year 3 rather than year 1 because you don't have cash flows in years 1 and 2. That effectively is a shortcut. I'm taking out the cash flow in year 1 and year 2. It looks like discounting, but that's just removing the cash flows in the first 2 years. It's not a discount. Basically, it is discounted. That 2238 is kind of a normalized, but I could have done a full-fledged capital budgeting and I'd have got a present value. I could have used that instead, just a shortcut to get to the same destination. So my value for Gulf Oil, to bring it in, I also have to bring in the developed reserves. They had enough developed reserves that all they did was took the developed reserves and got cash flows. They'd get 915 million every year for the next 10 years. That's a more traditional cash flow. I used a discounted cash flow valuation, valued that at 5.07 billion. Add that to my undeveloped reserves, I get a value for the entire company. Those of you valuing oil companies, let's say you're valuing ExxonMobil, you did the traditional DCF valuation, right? You brought it all in, you did a set of cash flows. Where did the undeveloped reserves show up there? Through the growth rate and through the expected cash flows. Here, this is a different way of getting to the same destination by dividing up what they do to developed and undeveloped reserves. Now, one of the things I would emphasize about these option pricing models is I'll wager 95% of you will not actually use the option pricing models to value real options in the future. But I wanted to think about the implications of looking at something as an option. Because what is this telling you about what drives the value of oil companies? Obviously, the level of oil prices is a factor. Higher the level of oil prices, the more valuable oil companies get. That's easy. But you know what this is also telling you? That the value of an oil company is a function of the expected volatility in oil prices. And I'm going to say something that's going to sound counterintuitive. Oil companies become more valuable as oil prices become more volatile. You see why? Because it adds the optionality to it. And a company like Petrobras is going to get even more valuable than one like ExxonMobil because ExxonMobil gets 90% of its value from developed reserves, 10% from undeveloped reserves. Petrobras gets about 60% of its value from undeveloped reserves. There's a lot more optionality. So you can see why optionality varies across companies. So that's the option to delay, and you can see it play out in those 2 big options. Let's talk about the option to expand. Again, let's go back to Corporate Finance 101. You have a project, you have compute the net present value, come up with a negative net premium. But what if this first project is tied to a second project? Where if what you observe on that first project is good, you will take the second project, an option to expand. I'll give you an example. Let's assume the Chinese government invites tenders from hotel companies to open 10 new hotels in some part of China that they think is, I don't know enough about China, North China, South China, somewhere towards Mongolia, not enough hotels. So, hey, we're opening it up to Marriott or Hilton. You can bid and you can build the first 10 hotels there. And you know that you look at the 10 hotels, a very, very risky part of the world. You don't know how many tourists will come in. You come up with a negative net present value. Your reaction to the Chinese government is no, thank you. They say, look, if you build these first 10 hotels, we will give you the exclusive right to build another 100 if you want to. You have the right to do it. You do the net present value of the next 100, you come up with a negative net present value and say, this is going from bad to worse. You're giving me a bad project, you get rights to an even worse project. But here's the difference of the second project. You don't have to take it now. You can wait until you observe. Do you see why this is your option here? You open the first 10 hotels, your expected values might come in. They're a terrible investment. You walk away. But what if more tourists come in than you expected? You're doing much better than expected. That option to expand becomes the option that then will lead you to take the first project. And a lot of people invest in China, especially early in this century, did it with negative net present value investments. You know why they did it anyway? It's a big market. And they said, if that first investment gives us the right signals, it'll give us a chance to do something more. So I'm going to use that as kind of a framework again for laying out the payoff diagram. The payoff diagram, the additional investment you got to make to expand becomes the equivalent of the strike price. Right now, the value of the cash flows you get from expanding, building the 100 hotels is lower than that. It's a out of the money option. But to the extent that that can change based on what you see on that first investment, you might take that second investment and make the difference. Of course, that might never happen, in which case, what did you pay to get this option? What did I say about the first investment? It has a negative net present value. That becomes the cost of the option. I'll tell you again why this matters in discounted cash flow valuation. The way we've done discounted cash flow valuation is we've taken expected free cash flow of the firm, discounted the cost of capital, come up with the value today, right? So let's say I did that for a software company. It's a software company that sells security software, basically protects companies' databases from intruders. You project the cash flows in the business, you come up with a value for the company of 115 million. And then I throw a wild card into the mix. I say, look, as this company runs its business, it's accumulating data on its clients. Because remember, you're getting data on who's trying to intrude. And you're going to take that database because it's going to give you a database of potential intruders and how they get in. And you're going to try to market that database. In other words, you're going to be able to sell. So you ask me, okay, that sounds interesting. How much will it cost to convert that database into a business? I say about $500 million. Say, okay, that's a lot of money. How much will I make by developing? And say, about 40 million a year for 10 years. Already you're saying, get out of here, right? You invest $500 million upfront. You don't even need to do present value. 40 million a year is 400 million. This is a, but I said, wait. There's some good news here. We know very little about this business. So how can there be good news? It's a lot of uncertainty, right? I know we're entering a very dangerous space here, but let's think of this as an option. The present value of the 40 million a year for 10 years at a high cost of capital gives me 226 million. That's what the present value cash flows is. How much does it cost me to get into business? $500 million. Negative net present value minus 274 million. But there's a lot of uncertainty. And you remember, this database is exclusive to you. Put in the 50%, it's like magic. You take a bad project, you add a lot of uncertainty, and what do you get? You get a valuable option. $56 million for the option. As you see people entering into AI and say, that makes no sense. Before you pass too much judgment, these people are not making traditional investments, they're buying options. The essence of options is it will not make sense based on the numbers today because they're out of the money options. That 56 million adds on. Again, as I said, I've never done this on an actual company after the fact to value the option, but I've made investment decisions driven by this optionality. I'll give you an example. I bought Facebook in 2012. They went public. I briefly held it for a year. I sold it. And of course, the stock took off. And for a brief time, it was this great, amazing company. And then Cambridge Analytica, remember in 2017, it was a huge scandal about their sharing data, about their clients. And the stock price dropped. And I did an intrinsic valuation. The stock had dropped to roughly what my value was. And I wrote a blog post and said, I'm buying Facebook. You could, the amount of, pushback I got was, because what have we been taught? You have to have a margin of safety. You got to buy below the price. And this is a risky company. How come you're not building a margin of safety? And I said why I was okay buying Facebook, even though the value is equal to the price. I said, when I did my valuation of Facebook, I valued it as an online advertising company because that's what they're doing. And right now, at least in 2017, I don't think there's a way they can sell retailing or entertainment or other stuff. They haven't, because it's not viable right now. I can't think of a way. But could they potentially do it in the future? You have 3 billion people on your platform, 57 minutes a day. You haven't figured it out yet. I mean, let's face it. You have WhatsApp right now. It's your cheapest and best investment ever. It costs you nothing. Unless you're one of the strange people who actually figured out a way to pay for WhatsApp. I don't know who's collecting the money, but it's free. But I promise you, Facebook is thinking of, is there a way I can monetize WhatsApp? It wasn't in my cash flows. Do you see where the optionality comes from? There's a big platform. There's exclusivity because this is Facebook's platform. There is a added value. I can't tell you what it's going to be because right now it hasn't happened yet. There's optionality here. It's an argument that's huge for Facebook, much less so for Snapchat, because when you have people spending only 5 minutes a day in your platform, there's not a whole lot you can do with them. But you have 57 minutes, Facebook is going to figure out a way with Instagram and WhatsApp, especially kind of locking you in. They're going to find other ways to make money from you. I haven't built it into my cash flows. This becomes that premium that allows me to buy Facebook, even though it's fairly valued, not undervalued. So something that comes into investment decision that comes from my thinking about options. So when you think about real options, it's not even that you apply an option pricing model, it's that gives you that insight that changes the way you think about a company. So many of you valuing companies, you're coming up with, some of you are coming up with values pretty close to price. You really, really like the company. I've given you an excuse for putting the buy on your company, even though the value is less than the price. Just use the word real option or optionality. I'm going to let you go on this one because it's your money. I don't care if you have optionality. But if it's truly optionality, you can see how this is, in fact, a rational explanation for it. It's actually my reason with Tesla that I've always been willing to pull the trigger sooner on Tesla. I've always bought Tesla at fair value. It's very difficult to find it significantly undervalued to begin with at fair value. Is there a lot of optionality in Tesla? Who creates all that optionality? One man, right? He tweets and he said, what? Is automated driving? I mean, let's face it. Not only does he tweet about it, it's a company that actually does something to move towards the optionality, right? Every other automobile company has been talking about self-driving cars for 50 years. GM has been, how many self-driving GM cars have you seen on the road? None. You can take issue. I actually was in a Tesla last week where the guy turned on the auto and sat in the passenger seat. Most terrifying experience in my life. There's nobody in the driver's seat. He said, what are you doing? I hid in the back seat, waiting for impact. I actually got home. I got out of the car as soon as I could. But let's face it, this is a company where there is a chance. I'm not saying the drive to automated driving is going to be smooth and unimpeded. There's optionality coming out of every pore in that company. A lot of it is out of the money. Those robots, have you seen the Tesla bots? You haven't seen them? You should go on Google, Tesla bots. It's a big deal. Tesla's come up with these bots. They're going to use them in their factories initially as replacements for their workers because Tesla bots can work 24 hours a day, and they don't make mistakes, But there's also this potential that if they work really well, Tesla could potentially sell the bots to other companies that have mechanized services. I mean, imagine that all the toll roads would be much better run by robots than the actual people sitting behind the counter, right? The guy's drinking a beer. He doesn't even see the car come by. You're waiting for 7 minutes. And he finally turns to you. What do you want? What do you think I want? I'm driving on the road. I want to get past you. And you're not taking my money, right? So there are lots of things where bots are going to be useful. That's an optionality that's not in the cash flows right now. So when you look at these real options, I want you to ask 3 questions. First is I've linked 2 investments, an initial investment, the second one. Ask yourself, do the two have to be linked? Second, where's the exclusivity? Right? With Facebook, the exclusivity comes from it's their platform. With Tesla, it's their technology. Opportunities are not options just because you have a big market. So that hotel example, there's no optionality if I don't give you exclusive rights to open the next 100 hotels. And how big that exclusivity will be will depend on what kind of competitive advantage, barrier to entry you have. So think through that, and I think you have the basis for real option. So let's pass this option to expand through. Is there an option? Yes. Where does the option come from? The underlying project and the fact that you have the right to take that expansion project. Is there exclusivity? That here it's messier than patent because it depends on how much exclusivity you give it. And finally, can I use an option pricing model? I'm still on dangerous ground, right? It's tough to trade the underlying asset, impossible to trade the underlying asset. The option doesn't get traded. Replication arbitrage gets much more difficult. So option to delay, option to expand. Let's talk about the option to abandon. Is it nice to be able to walk away from your mistakes? In life and in business, it is nice to be able to walk away from your mistakes. That's what the option to abandon is. You take a big project, things don't work out. It's nice to be able to abandon the project. When would you do it? Not when the project is doing well, but when it's doing so badly, you say, it's not worth it for me. I'm willing to walk away, even if I lose half my money, because staying in this project, I'm going to lose even more. It's the only put option you're going to run into in the real options world. So I'll give you an example. Your Airbus. And I am Lear Aircraft. You heard of Lear, it produces mostly corporate jets. We both see that Boeing is in trouble. So I come to you with a joint venture. I say, look, I'll put in half the money, you put in half the money, $500 million each, and we'll start the business. So your Airbus, you work through the numbers, you come up with the present value, the cash flows in this joint venture, you come up with $480 million. So how much I'm asking you to invest? $500 million, you're going to get $480 million. You say, no, thank you. But I really, really want you as a joint venture partner. So I make you an offer. I said, look, I know you're worried that this will not work out, but I'll give you the right to walk away from this investment anytime over the next 5 years, and I'll pay you $400 million for your 50% stake. So what have I given you? I've given you a floor on your value. You cannot lose. You invest $500 million. The most you can lose is $100 million. I've given you the option to abandon. It's a put option. Let's flesh the rest of the details out. Now, if you do a simulation of the cash flows, it turns out that the present value of the cash flows that come up has uncertainty in it. Let's say the variance is 0.16. And let's assume that this project itself has a 30-year life. So here's what the inputs to my option pricing model will look like. First, the value of the underlying asset is the present value of the cash flows today, $480 million. The abandonment value is $400 million. So will you abandon today? No, because you're going to get only $400 million. It's an out of the money put option. You have 5 years to play this game, and the variance over that period is 0.16. And remember, it's a finite life project. So every year, the project actually gets less valuable. It goes 30 years, 29 years, 28 years. That becomes the cost of delay. I plug the numbers in. Here's the magic again. The value that I get for the put option is $73 million. Your Airbus, why were you initially reluctant to invest? Minus $20 million NPV. I gave you the right to walk away. Basically, you're going to be more willing to take this project now because I gave you the right to walk away. Again, you will never use a Black-Scholes model, I'm sure, to value an option to abandon. But think of what this tells you. It gives you a measure of how much flexibility, adaptability is in a company. Now, sometimes you hear these as buzzwords, right? Especially after 2020, you want to build an adaptable, flexible company. Let's say you're valuing two companies. They have exactly the same cash flows, but one company you believe is more adaptable and flexible. It's designed. This basically says that company should be worth more because that flexibility gives them that option, the put option to be able to walk away from the mistakes. I know lots of people are told, show conviction, don't have escape hatches. That's the absolute worst advice you can give businesses. Show no conviction. Act as if things are going to blow up. Build in escape hatches because that's what's going to save you when things start to come apart. So it essentially is a way of taking that word, flexibility,
and saying, this is why it matters in evaluation. It adds that optionality to your company. There was a time when Goldman Sachs traded at a much higher price to book ratio than any other investment bank. You know what lay at the heart of Goldman's reputation, right? When good things happened to them, they found a way to make things better, call options. And when bad things happened to them, they managed to escape quicker than everybody else, which is another way of saying put options. They had a lot of, that reputation is now gone. But as long as they had the reputation, they traded a premium. This is the base of there's optionality here. I'll at least get started on the last set of options, at least in this context. In corporate finance, we run into options all the time, but usually in the context of being parts of securities. Convertible bond is just a common stock with a call option. A bond with caps and floors on the interest rate is options in it. I have zero interest in going there because I don't teach a fixed income class. But there's another place where optionality comes in. In my corporate finance class, we're talking about optimal capital structure right now. What's the end game in optimal capital structure? We try to come up with the right debt ratio for a company. So you should be at 30% debt. Let's say you have a company that is at 5% debt and your optimal is 30%. You say, when do you move to the 30%? I'm going to play devil's advocate. I'm the company. I say, look, I don't want to move to 30%. I know I have excess debt capacity. You say, why? I say, because I value financial flexibility. What does that mean? I want to keep that excess debt capacity in case something great comes along, because then I can use that debt capacity to do an acquisition, take a great project, invest in a new technology. And I've always struggled with that because in capital structure, you get this argument for every company, especially with too little debt. We value financial flexibility, therefore we don't borrow money. I want to start at least you thinking about, financial flexibility is an option. Because why do they want to have a low debt ratio? Because they want the option to be able to borrow money to do stuff out there. How much is that option worth? And the next class, when we start, we're going to start with valuing financial flexibility as an option, again, with the idea of saying what kinds of companies should be under-levered, should maintain that, and what kinds of companies does that make no sense? So I will leave you with that thought, and I will see you on Monday. And Monday, we will complete the option pricing section and perhaps start on acquisitions, but we will definitely be done with the option pricing.